People in finance are lying to you. People in finance tell you if you just save for long enough, you buy the S&P 500, you buy crypto, you buy property. Then if you do that for long enough, you can live off passive income. But this is not true. It used to be a very good time to follow that plan, but it's not anymore. What we're seeing here is the S&P 500 dividend yield starting in 1860. So that's more than 150 years of data. The current dividend yield is at 1.14%. Now, some people might say, if your portfolio is large enough, then even if it's just 1.14%, that's not a problem. The truth is, it is a problem. Even officially, the inflation rate in the US, the CPI, is on average at roughly 3.3%. And that's just consumer goods, right? Consumer goods over time get easier and easier to produce, and that's why the inflation rate tends to be relatively low. If we look at other things that are not easier to produce over time, those prices tend to rise much faster than the 3.3%. Now, when the inflation rate is higher than what we make with the investment, the active ROI, the dividend payments or the rental yield, etc., that means over time we have to sell equity. We have to actually sell stocks. We can't just set and forget. Realistically speaking, the situation is much, much worse. The monetary base expands by 6.8% per annum. So really, the things that aren't easier to produce over time, the prices of such goods and services increase with 6.8% per annum. Now, why does all of this matter? It matters because getting cash flow now from investments is incredibly hard. Too many people have saved too much money, have made returns on those investments. The investments went up in price, but actually getting a cash flow, a regular cash flow return from those investments is incredibly hard. In other words, the market is willing to pay enormous amounts of money just to get very small cash flows. Cash flows are expensive. Cash flows are actually the hard thing to come by. So really, the target to be financially free should not be to have X amount of dollars. It should be to have X amount of regular monthly or yearly cash flows. It's cash flows that matter. It's not net worth. So let's think about the common route. Let's say you've got a regular job. You enjoy that job a lot. You get paid a lot for that job. You don't have to put in too much time into that. In general, you would do that thing anyways, no matter if you would get paid for this or if you wouldn't get paid for this. That kind of cash flow, if it's stable and predictable, might be worth more than a multi-million-dollar portfolio. Everybody that's got a portfolio is speculating on increasing prices. Nobody is really hunting cash flows anymore. Everybody has to sell an asset at some point to get adequate purchasing power back. Cash flow is a thing of the past. The monetary debasement effect, the 6.8%, is a massive problem. Have a look at the S&P 500 relative to the monetary base. So let's say the Federal Reserve was not to print money all the time. There wasn't credit creation all the time. Instead, we had a constant monetary base. Then the S&P 500 would return what we see here in this chart. This is a chart that starts in 1959. And yes, we could make the argument that there was some growth over those years, 63%. But we could also make the argument that maybe there's some kind of fair value, maybe the average value here, right? This dotted line, and we just oscillate across that fair value. Here's why this might actually be a more realistic assumption. Have a look at the Shiller PE ratio, the price to earnings ratio of the S&P 500. How many years of earnings do we currently pay when we buy a share of a company? So that's effectively what we're doing when we invest in the stock market. We are buying the future earnings of a company, and the price to earnings ratio just says how expensive is the company now compared to the earnings. It is at an historical high. And let's say a 40 PE ratio isn't really sustainable. Again, this is a very long-term chart starting in the 1870s. Let's say this was to come down slightly. Maybe we aren't going all the way back to 5, but maybe we go to 25. So a drop of a PE ratio from 40 to 25. That brings us a 38% decline roughly from our current value, down 38%. Brings us here, very close to what could be considered the equilibrium. This 38% drop It brings us exactly to the level where the S&P 500 started on this chart in 1959. Isn't that interesting? The S&P 500 is basically appreciating at the same rate of the monetary debasement. And if we take away, at least partially, how much valuations of stocks on average increased versus their earnings, we have no gain at all. So it's really not that easy, right? Just because we have a large portfolio doesn't mean that our life is solved. Now, of course, if you've got billions and billions of dollars, and if that gets cut by 90% and we still would have hundreds of millions of dollars, that doesn't really matter. But if we are, say, just in the $2, $3, $4, $5 million mark, while in theory we might have enough money for a lifetime, the monetary debasement is strong enough of an effect that we still need to be very smart about our investments. We can't just set and forget. We can't just put money into the S&P 500 and live off the dividend. People are willing to pay a lot of money for cash flow. Again, almost 100 times the annual cash flow. Let's say you've got a small micro business, and let's say you don't have much effort with that. You do very little operations. You've got outsourced it all. Let's say this makes $500 a month. That's cash flow. That's equal to $6,000 a year. Now, if you wanted to get $6,000 a year just from dividend payments, then you needed to have $500,000 invested. Your little side hustle, at least to you, you cannot necessarily exit that company and sell it for $500,000, but at least to you, in terms of cash flow, is worth $500,000. So really, cash flow is king. It's not net worth. The market is paying an arm and a leg just to get a little bit of cash flow. So I hope you get something out of this perspective, right? Just because you've got $1, $2, $3 million doesn't mean that all of your financial troubles in the future are solved. It rather makes life more complex. Now investing becomes a real tough game. It's much better to focus on cash flow that's predictable and that's easy to generate, and then try to grow that. And just a little bit of extra income every month will make a lot in terms of net worth. It will build your wealth quicker than if you were to just save and invest. The compounding that we get with investments is simply just fighting against monetary debasement. It does not necessarily buy us more stuff. If it's your first time here, feel free to subscribe. I publish videos regularly. Feel free to also check out the premium membership. This is where I share my own trades. This is where I share how I manage my portfolio. So see you next time on YouTube or see you on premium. Cheers.